Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the stock play of the day. Today's stock is the QQQ. That's the ETF that tracks the NASDAQ. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today, we're going to kind of change the theme of the show. The show is titled Stock Play of the Day, but today we're going to talk about protection. Is it time to think about protection and how to use options as they were first intended as vehicles to help insure something? So that's going to be the moral to the story, a little bit of a different twist, but let's start by looking at the markets. I currently have my VIX watch list up, and we do see the VIX trading around 32. Now, yesterday, it bumped up against the 40% level in the VIX index. We saw it actually, let's see exactly where that high was. Not quite at 40. If I look at it, we got a little bit close to that. But in my mind, I was very surprised to see it come down, even though we had a rally into the close, which was a very odd rally to say the very least. We had the VIX come back down to the 30% level. And I was surprised to see it just in that range. I kind of thought that we might spike. 40% is considered extremely high volatility. Going all the way back to the pandemic, we haven't touched the 40% level that often. So, like if I zoom out on my VIX chart here, at my line in the sand, which is the 20% level, which was kind of set during the big downturn a couple of years back, almost a couple of years back now. But we see how many times we've actually came up and touched or went through that 40% level. There's one, I guess we'll call that two, three, 3.5. All right. And now we almost hit it here. And when you consider the panic of the marketplace yesterday, I think it was interesting that we didn't quite blow through that 40% level, which to me, I guess, since the pandemic would now be considered extreme volatility. Anything up above that 40% level, I don't mind that it's actually trading right around that 32% level. That means that there's a lot of angst in the marketplace overall, more than normal, but it's not outrageous. I'm kind of surprised, bluntly, that there isn't higher volatility right now. So now, with that said, I think a lot of people talk about the VIX as the fear index, but they don't really give a little bit of a background on it. Why do they think the VIX is the fear index? Does volatility mean that the market's going down overall? And the answer, in short, is no, it does not. Volatility has no regard to direction. This index tracks the options that are traded in the S&P 500 index. And those option contracts, usually in the S&P 500 index, if you look at open interest on the call side and on the put side, you will note that in even normal times, you will usually see more put open interest than you will call. And the reason why that is because this is an index that a lot of hedge funds, that a lot of institutional traders, a lot of people in general like to buy puts as protection, which options were first intended to do. Why? Because it's a big index. It's easy to do. It's cheaper than insurance. It's a cheaper form of insurance than buying puts on all the individual stocks in your portfolio. You can buy one that kind of tracks your portfolio if you have a lot of stocks in the S&P 500 index, that is. And so that's the main reason why you see that. Okay, so now why do people call this the fear index? Well, when people are nervous, they're going to run to protection a little bit more than they would in normal times, quote unquote. So because of that, a lot of times people buying a boatload of puts as protection will actually increase the put value in the price. 1 second. I'm going to be struggling a little bit. I got a little bit of a tickle in my throat, but I'm going to make it through this. Okay. So if I'm buying that put and I'm paying up and I'm scared and I'm frantic and I'm willing to pay anything for those puts, that by definition, the only thing that can increase in an options price without regard to stock price movement is implied volatility. I can't change other things like the timed expiration, right? That's built into the contract. Where the current interest rates are at, that's already a known factor overall. The one big thing that changes options inside the model is implied volatility and price. So, what happens and why do they call the VIX the fear index? Is because as institutional investors, retail public say, I want to buy some protection for my portfolio. What has just happened has made me nervous. And they start buying up puts. The only way that market makers can react to get them to stop buying them is to start increasing the price of those puts. When I increase those prices of those puts, in regard to the price of the actual S&P 500 index, that means that I'm pumping up implied volatility, hence the fear index, right? That's where it all comes from. So that's the moral to our story today. We're going to talk about buying puts as protection in indexes. Now, we're going to look at ETFs. The QQQ is the NASDAQ one, and the NASDAQ is a little bit uglier than the S&P 500 index. It's a story of two charts, and we had a little bit more nervousness today than we were yesterday, actually, and we still see the VIX around 32. And here's the reason why. Let's just look at the chart. Okay, so here's my S&P 500 index chart. It's a one-year chart overall, but more importantly, it's all about the moving averages and what's going on in the marketplace. The moving averages look scary for the first time in a while. I have a blue trend line. It's not really highlighted here, but we broke through this trend line to the downside and things got ugly. Got a lot of red candles here. But we've always had our ducks in the row so far. We've had the 200-day moving average below the 50-day moving average, below the 20-day moving average. But look at right now, we have a death cross that is potentially happening between the slower moving averages. And then also on the 200-day moving average, we had a breakdown. And it didn't even pause at the 200-day moving average. Strong breakdown through it. Now, for the longest time, the 50-day has done a lot to support the S&P 500 index. And that's broken down a few times recently. But now to see it just come skyrocketing down to the 200-day moving average and continue right on through that, well, this was what was holding up the marketplace. Not quite sure where our next stopping point might be by looking at the chart, but now everything is into play. If we go all the way down to the 4,000 level, is that feasible? Is that at this point in time, I don't really want to, I don't really have any good insight as to where it could be targeting for a level of support. Maybe we get a bounce back. You never know at the marketplace overall. But if we go and now look at the NASDAQ chart, and I'm going to use the QQQs because that's the ETF that we're going to talk about today. And we see that we had that breakdown a few days back. Had the green day yesterday just for a split second at the end of the market. And now we're back to red again. Excuse me. Okay, so this chart looks bad. This chart looks worse. Overall, they're just not pretty pictures. So how can we stay in the market if you wanted to, like most of the time, and we usually preach this within Ally Invest, Lindsay Bell and a lot of her quarterly and weekly outlooks are, if you're in it for the long haul, there's going to be some volatility near time, but over the long haul, usually markets will repair themselves. So sometimes it's best to just stay the course. Maybe you just want to go and hibernate for this week. The weather has make you weather across the nation kind of makes you feel like you just should hibernate, period. But with that said, you either just let it ride and try to work through these, continue to dollar cost average, continue to readjust your portfolio to try to stay diversified overall. Those are some very simple things that you can always read up about and that you always want to try to implement. But I'm going to give you one solution that if you're nervous and you just want to hang in the marketplace, but you're nervous short term, here's a trade that you can do to try to help protect a portfolio. But it's very important that you pick an underlying, an ETF or an index that tracks your portfolio, that has similar stocks inside your portfolio. And you can actually do this if you go to the Ally Invest. I'm not going to go there right now, just not going to have the time. But if you go to the Ally Invest stock research site and you put in an ETF, it will give you the top 5 holdings in that ETF. I want to let you know. So you can find that information in a lot of places overall. Okay. So long put spreads. Buying puts outright, which you might have thought that that's what we're going to talk about today, is expensive. And I don't always suggest it. In certain situations, I might buy a put, and you'll talk to some hedge fund managers that will keep puts on all the time, and they're continuously rolling them. That's a totally different strategy overall. We're just looking for something very short term that can help get us through this next couple of weeks, get us into February, and give us some protection near term. And when implied volatilities are high and you're buying insurance, I'd much rather look at a long put spread than look at just buying the put outright. In other words, if you think about this as a homeowner and you're thinking about buying insurance, well, you're buying insurance. Well, the hurricane is forecasted to basically hit your shores, right? Because we already know the forecast, and now we decide to buy insurance is going to be more expensive because we've already seen the downturn. We've already, I got to cough again. One second. We've already broken through the 200-day moving average overall. And now we're looking to buy insurance. So it's going to be expensive. So we're not going to buy the most expensive policy. We're not going to buy those inflated priced options. We're going to buy some and we're going to sell some. So we're going to buy inflated priced options and we're going to sell inflated priced options. The downside here is that we're going to have limited upside as the market goes down. So we're going to buy a put at strike A, and this is going to give us our protection. And we're going to say, that's great. And we're going to be protected basically from strike A to strike B. But then from strike B on down, we're not protected anymore. But at least it gives us a little bit of protection in a rough marketplace, but not as costly. Okay. So we're going to not pay as much, but we're not going to get as much either. Okay. So there's so many different ways that you can say this overall. So if you're worried about the 10% correction that a lot of people have talked about from this point, not talking about from the initial downturn, but from this point on, how would we approach this strategy overall? Okay, so let's go to the Ally Invest option chains. We have the QQQ up. We're down 3%. Now, that's nothing to sneeze at. That's a very big downturn overall. Okay, so now the biggest question is, if I do have a portfolio of stocks, and we'll make it a round number, $100,000. I have a portfolio of $100,000 worth of NASDAQ stocks. My position is down about 3% today in general, if it's tracking the NASDAQ or the QQQ. And that QQQ is trading at $342. Okay. Simple math, not, I should say dirty math, because it's not a perfect formula, is to take the value of the QQQ, which is 342, and I'm going to do it here right on my calculator, and then just multiply it by 100, and you come up with $34,200. So each put that you buy should represent approximately that amount of insurance, approximately. Obviously, that's not, you can just tell that that's not going to be a perfect science, but it gives you a suggestion. So if we got 34,000, so if you take that and you times it by 3, you're going to be close to $100,000 worth of portfolio insurance. You want to buy a little bit more, maybe you buy 4 of them. obviously each one that you buy is going to cost you money. So you need to hope that if you buy this insurance, your ideal situation is that you don't use it. So you're buying this as protection for the short term, but you would really like your portfolio to go up in price. That would be your best case scenario overall. So with this said, if we look at the cost of our put spread, you got to realize that every one of these, it represents $34,000 approximately of insurance, but they're going to cost at the midpoint, if we filled this spread, of $3.75, we'll call it right there, or $375 per one by one spread. Now, what does that give you? Okay. So I went out and said 10% from 343. So about 34 points would be 10%. I took about half of that. I'm saying I'm going to take on that first part of risk. I'll take on that first 5%, but I want to be protected if it goes more than that. And so I'm going to do 20 points wide. I'm going to go out 13 days. Now, insurance is expensive. So we're using 13 days. You can go out as long as you want, but obviously it's costly. And I just want to get through this little time period and get us into February and get us into tax season, actually, overall. So we're looking for something to give us a boost in the marketplace. And if we do this trade, you decide this expiration, but the fact that we're doing spreads and we're lowering our cost overall, I wouldn't mind doing, if I wanted 30 days worth of insurance, I would think about doing two 14 or 13 day, which is our expiration today, two 13-day spreads. I'd rather do it that way because of the way the spreads pay out at expiration, which we're going to get to here shortly. Okay, so if $100,000 portfolio, I'm going to go down to the 330 level. That means my deductible is from where the stock is at to the 330 before my insurance kicks in. And then we're going to go all the way down to 310. So it's a 20 points worth of insurance on the QQQ that I'm looking to buy here. Okay. Just like most insurance, you have a deductible. It's not going to kick in until we get to 330. You did your car insurance, you usually have the $500 or maybe the $1,000 deductible. If you lower your deductible, you lower your cost. That's what we're doing here. We're taking on more initial risk, but if we get down to that nervous range, down about 5% or so from this point on, then I want my insurance to kick in, and I want it to protect me for the next 13 days. That's the concept. So if this was a $100,000 portfolio, we usually do our paper trades. They're usually done as one lots, one by one. So we're going to say, well, we would do approximately 3 spreads to try to protect a NASDAQ looking $100,000 portfolio. I'm going to put this in the right way. Emphasize, not meant to be a recommendation. As always, we're just trying to learn. And if you're trying to implement the strategy in your own portfolio, you want to think hard about what that underlying would be. If you want to use an ETF, if you want to use an actual index, the cost of the options, everything that goes along with it. Okay. So now this has actually gone down a little bit. So we said 355, it's 366. I guess we'll click here. We'll say 365. Okay. And I'm going to have to cough one last time. Okay, so now I'm seeing, if you have questions, please put them in the chat box. I'm going to try to address as many as I can. I know I'm getting a little long right now at this point in time, but please put those questions in the chat box. And as you're doing that, I'm going to scroll down. We're going to look at the Ally Invest profit and loss calculator. Okay. So now, if I look at the calculator, this kind of shows you something about the spread. Okay. So we're doing the spread. We're buying an expensive option that's inflated because of volatilities, but we're selling one also. So to start with, if the market does go down right away, and it comes all the way down to that 310 level, that kind of line in the sand that we're kind of hoping that we get that little pullback before we start going back forward. That's just what markets have had a tendency to do. never guaranteed looking back, versus forward, that you're going to have the same type of outcomes. But with that said, so to start with, if it happens right away, you don't benefit as much from your spread as you would if it happened at expiration. Here's the profit as of today. If it collapsed to 310, here's the profit at expiration. So let's move the days to expiration. We're going to go all the way down to 1 day. Now you see that our colored line as of today, now this is a theoretical pricing model, looks a lot more like the dotted line. And at expiration, it would be closer to that. This is why, if I wanted some protection and I was thinking about a month, I would probably buy 2 short spreads because it gives me an out point. It gives me the benefit if the market comes down, I get rewarded via my insurance policy for being in a shorter time frame because time is a battle in this instance, in that if you sell a put option, you want the market to go up. You buy a put option, you want it to go down. So they fight each other. So the only way that you can get the maximum of that put spread that you're buying as protection is to be close to expiration and have that short put that you've sold lose time premium. All right, everyone. So as we come to the end of our stock play of the day, I see a few questions. I see, well, William. Hi, everyone. Hello, William. If you have any general questions about a portfolio, what do you think your portfolio looks like? Do you have more NASDAQ stocks? Do you have more S&P stocks? Do you not know overall? Just let us know your thoughts about this strategy and this outlook. Like I said, a little bit of a twist on the stock play of the day. But last week on my podcast, Options Playbook Radio, talked a little bit about getting bearish on the market overall and foreshadowed talking about buying long put spreads as protection as opposed to buying puts outright. Now, this week, I think we had it. Everybody was running for their fallout shelters yesterday until noon. Well, I guess until about 3 o'clock. And then all of a sudden, everybody's like, what just happened? Overall, now I don't need protection anymore, right? The market came back. Why do I need protection? Why do I need to fix the roof when it's not raining? Because when it's not raining, it's not leaking. Overall, I guess that would be the analogy. But if I'm doing this, it's an interesting way. It's not that expensive if you do it on a shorter term basis. I don't want to do this strategy long term. I don't want to go out 3 months and continue buying insurance. That's not my overall in the marketplace. You're trying to remain long for the long term. This just would get you through a nervous period in the marketplace overall. Okay. So William does ask, do you expect this trade to just expire? I would ideally like that, right? Shoot. William, that's a great question because I'll ask you this. I'll rephrase it back to you, William. William says, do you expect this trade to just expire? When you buy car insurance, do you expect it to just expire? Is that what you would like to have happen? And I would say, yeah, because that means you didn't get in an accident overall. And ideally, that's why we want to keep the cost low, and that's why we're doing a spread, is that our best case scenario here is that the market does go up and our portfolio gets us back what we paid for the insurance policy plus better than that, right? Plus more. And that's our best case scenario. Now, here's where the annoying scenario would be. Now, this is in our profit and loss calculator. This is our where the stock is at right now. The most annoying case would be that we went to 13 days and the stock stopped at 330, right? We got no benefit from our insurance because it didn't hit the deductible. It didn't hit our deductible, and we made no profit, got nothing back at all from doing our long put spread. So if it stopped right at 330, you'd be a little bit annoyed overall. But that's the concept of it. So it's kind of like having a fender bender instead of an accident. You have that fender bender, You have $1,000 deductible. You got to replace your bumper, and that happens to be $800, and the insurance didn't help, and you had to come out of pocket for the $800. Okay, so I'm trying to give as many analogies to what this is really intended to be, an insurance product that will protect you. Now, you want to move this up, you want to buy the 330 strike, that's fine. It's going to cost you a little more. You want a little bit lower deductible, it's going to cost you more overall. But you pick those ranges, you pick the underlying, and this is just a thought. This is actually what options were first intended to do. They were intended to be used for protection as opposed to speculation. So I just thought that that would be a great little topic for today. All right. Any other questions? Thanks for soldiering on. Thank you, Clinton. I apologize. I wasn't coughing this bad before the show started. If you buy an option and want to exercise it early, is there a button for that? You mean like a um, I'm trying to think of the Staples button that you hit when you want to exercise an option contract. No, you have to call. Some brokerage firms might have exercise ability through their online platform. Through Ally Invest, you're going to have to call if you want to exercise your option. And here's part of the reason why. Not many people do in the first place. But in the case of long puts, it happens more than long calls, because you're just selling your stocks and you're getting out. In our instance, we'd probably want to close it. About 10% of options over the years have been exercised. Year after year, the Options Clearing Corporation puts out those numbers, and they really don't change that much. Only about 10% of options actually get exercised. But in the case, it happens more often in puts, because when you exercise, you get cash, as opposed to calls, where if you exercise, you spend cash. People would rather get cash than spend it. So you will see it more often in puts than you do in calls. Thanks, Ryan. But review your session one more time. Review your session one more time from Z. I'll just say Z. Okay. I'm not going to be able to go through the whole thing. The concept is that if you are buying insurance and you want to do it on a little bit cheaper but less exact way, think about ETFs. Man. Think about ETFs or think about indexes. And the way, a quick and dirty way to try to figure out how many puts you would buy as protection is to take the value of the ETF, in this case, the QQQ, and multiply it by 100, which is the number of shares the put option would represent. And you come up with about $34,300 worth of portfolio insurance. You might want to err to the side. If you have a $100,000 portfolio, I mean, you'd buy 3 put options. I would maybe buy 4 just to be safe, because it's not an exact science. But you have to decide that and where you would want to be. And that's the moral to the story today. We're looking at long put spreads as protection for your portfolio, specifically that tracks more NASDAQ stocks. That's why we use the QQQ today. That's it. This Friday, we're not going to have a stock play of the day. We won't be able to tape this show this Friday. But please click subscribe, ring the bell, and we'll see you next Tuesday for the next stock play of the day. Thanks for coming, everyone.